September 15th, 2008. On a Monday morning in New York, employees of Lehman Brothers walked into their offices expecting another normal day. Coffee sat quietly on tables as traders prepared for the markets to open. But something felt off. Inboxes filled unusually fast. Phones wouldn't stop ringing. Market screens that usually tracked steady movements were flashing red, again and again. Inside the building, confusion quickly turned into tension. No one could explain what was happening. Executives whispered behind closed doors. Urgent calls were made. Within hours, the truth could no longer be contained. Lehman Brothers was collapsing. One of the most powerful financial institutions in the world was falling apart. And it wasn't alone. A chain reaction followed. Markets crashed across the globe. Billions were wiped out in hours. And panic spread rapidly. Nearly $19 trillion in household wealth disappeared. Unemployment surged from 4% to 10%, and stock markets plunged. This was becoming the largest financial crisis in modern history. But this didn't begin in 2008. To understand it, we have to go back to the early 2000s. After the dot-com crash wiped out $5 trillion, the US economy was struggling to recover.
I had bought stock in Sun, Selectron, Yahoo. I'd done my research. I didn't think I was stupid.
The Federal Reserve stepped in, cutting interest rates to just 1.75%, the lowest in 40 years, making borrowing cheap and accessible. At the same time, the government pushed a powerful idea: home ownership. Owning a house became the American dream. With low interest rates spread over 20 to 30 years, millions of people rushed to buy homes they normally couldn't afford. Institutions like Fannie Mae and Freddie Mac helped keep the system moving by buying loans from banks, allowing banks to quickly recover their money and lend again.
Without Fannie Mae and Freddie Mac, the modern American economy simply can't function.
At first, loans were given carefully to people with stable incomes. But over time, that caution disappeared. Banks realized they didn't have to wait decades for repayments. They could issue a loan, sell it almost immediately, get their money back, and issue even more loans. This created a powerful loop. More loans meant more buyers. More buyers pushed prices higher, and rising prices encouraged even more lending. Then came what was known as easy credit. Loans were handed out to almost anyone, even people who couldn't realistically afford them. Subprime lending grew rapidly, especially under shadow banking, targeting high-risk borrowers with poor credit, unstable income, or no financial history at all. It didn't seem dangerous because housing prices kept rising, masking the risk. To handle the growing number of loans, banks created mortgage-backed securities, or MBS, bundling thousands of mortgages into a single investment. These were sold globally to banks, pension funds, and insurance companies. Investors were told these products were safe, often receiving AAA ratings from agencies like Moody's and Standard & Poor's, even when the underlying loans were risky. Then came leverage. Banks and financial institutions began borrowing heavily to invest even more into these securities. Instead of using their own money, They used borrowed funds to multiply their profits. The system became deeply interconnected. Investments spread across Europe and Asia, reaching institutions like HSBC, UBS, and Deutsche Bank. A single homeowner in the US missing a payment could now impact investors across the world. For a while, everything seemed stable. But between 2004 and 2006, the Federal Reserve began raising interest rates. Monthly mortgage payments increased, especially for adjustable loans. People who were already struggling began to fall behind. Defaults started slowly, then accelerated. And then, people simply stopped paying. What followed was a domino effect. Missed payments led to foreclosures. Housing prices stopped rising and began to fall. Buyers disappeared. Banks lost liquidity and could no longer continue lending or support businesses. Homeowners realized something devastating. They owed more than their homes were worth. Even if they sold, they would still be in debt.
I don't want to lose my house. I worked hard for this. It took me 10 years to get this house.
Many made the difficult decision to walk away. Then, the system broke. Mortgage-backed securities began losing value. Banks could no longer use them as collateral. Trust disappeared between financial institutions. Lending froze. Companies began collapsing, and stock markets entered a free fall. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest in US history. In that moment, the government realized that if Lehman could collapse, no institution was truly safe. Emergency action began. Central banks injected massive funds into the system. Over $85 billion was given to AIG, one of the largest insurance companies in the world. AIG had sold credit default swaps, a form of insurance that promised to cover losses if these securities failed. When they did fail, AIG couldn't pay. In October 2008, the US government launched the Troubled Asset Relief Program, or TARP, a $700 billion bailout to stabilize the financial system. While major institutions were saved, millions of ordinary people lost their homes, jobs, savings, and pensions. Anger grew as protests spread, and the crisis turned into a global recession, the worst since the Great Depression.
How many of you people want to pay for your neighbor's mortgage that has an extra bathroom and can't pay their bills?
To recover, interest rates were cut to near zero, and in 2009, President Barack Obama signed a $787 billion stimulus bill to restore growth. The warning signs had been there, but risk was rewarded and ignored. Afterward, reforms like the Dodd-Frank Act of 2010 and Basel III were introduced, requiring banks to hold more capital as a safety buffer to survive economic problems. Markets recovered, but risks remain. One thing remains certain. We may one day wake up to a screen with red numbers, beeping continuously, ominously. This time, it might be the end of humanity,